it over. It's all yours.
Oh, thank you for the introduction, and welcome this morning to a presentation here with my colleagues here at Raymond. Very timely topic, very, I think, hot topic in the world of business right now. We, as a firm and as a merger acquisition group, have seen a large increase in the amount of transactions that our clients, both on the buy and sell side, are participating in. So we're gonna, up on the screen right now is just a quick kind of overview of what the day looks like. I'll kick it off talking about the, what it looks like selling to a private equity firm. What are they? How do they operate? What a realistic kind of time frame is in that process. And then my colleagues will cover the rest. Don Burke will talk a little bit about net working capital and EBITDA, what they are and what they mean. Adams Williams will get into a little bit of the tax nuances, very common structure we see in a lot of our client base in this middle to lower middle market. And then last, Greg Light from our valuation team will talk a little bit about business valuation in the M&A and transaction space. So with that, I'll jump over into one of the first questions that any business owner needs to wrestle with before even thinking about, who is my potential buyer, is really, is it the right time to sell? And that means a lot of different things. That question can be answered in a lot of different ways, depending on the individual, depending on the business. But here's just a couple things to keep in mind if you're asking this question of yourself, or if you're helping somebody who is, and when is the right time to sell? So typically, the best time to sell from a business owner perspective is when there's growth on the horizon, or the business has really continued to grow strong and has a long track record of growth. Obviously, any buyer wants to partake in that upside, and a lot of times they believe they can come in and help accelerate that growth, or magnitude that, multiply that growth, whether that be synergies that they have with other companies in their portfolio, or things that they can bring to the table, liquid capital to fuel growth. The other is market conditions. Are they favorable? And a couple things that go into that: strong economy, low interest rates, high transaction rates. So everything that's going on right now. So in my career, I don't know that the market's has ever been more favorable than right now. There's a lot of, quote unquote, dry powder is a term you'll hear in the private equity space. That means there's a lot of money that has been pushed into that market. Those groups are very active, looking for companies to purchase, putting the money that's been committed to their funds to work. And low interest rates lead to the ability to leverage purchases, so they can borrow money to get the purchase done at a higher transaction cost at a lower rate. And the biggest question, which is really a personal one for the business owners, is: are you ready to move on to that next stage of your life? How are you feeling about an exit? A lot of business owners have spent their blood, sweat, and tears building this business, or their family over generations has, and how do you feel about letting that go, turning over the reins to someone else? The other is, do you as the seller have a good, clear vision of what your long-term objectives are for the family, for yourself, for the business? And then the biggest question that we get asked, and a lot of time that our Raymond Wealth advisors spend working with clients, is, will the transaction result in enough money for you to live on the way you want to live the rest of your life? And what does that look like? And how does it change? We find often in this market space, a lot of business owners, their net worth is tied up into this one asset, this business, again, that they've spent their life building. And now all of a sudden you're going to turn that into a liquid asset and put it into an investment portfolio. And how does that work? What does it mean to you? And on the tax side of myself and Adam Williams, we spend a lot of time working with those clients on the front end, helping them understand, the number that you've been given is not necessarily the number that hits your bank account when you go to the closing table. Obviously, there's things to be paid off, there's taxes to set aside, and helping clients understand that's very important. And we'll move on to the next slide now. So the topic of today's conversation is a lot around private equity. They're the largest buyer group out there right now in the marketplace. And, we typically have to answer a few questions on the front end of really, what is private equity? What are private equity firms, and how do they work? And so private equity is just a form of financing where money or capital are invested into a company from the private market. And what is a private equity firm? They're an investment firm that essentially, develops what is defined here below, a private equity fund, where they have limited partners who commit capital to put into that fund. Typically, the funds have an investment strategy around type of business, size of business, what is their potential time horizon for an exit, and then a lot of consideration for those limited partners goes on what's the track record of that private equity firm? Are they successful? Have they produced a lot of returns for the group? Typically the limited partner in a private equity firm, this is a small piece of their net worth. It's a riskier asset class than others that they have wealth tied up into, but they're very high net worth individuals or institutional investors such as pension funds and other businesses. And so they have a small portion of their net worth tied up into a private equity or alternative investments. And when private equity firms look to invest in a company, more often than not, they're taking a majority stake in the ownership. Now, there are transactions out there, and we see them, not unheard of, where there's a leveraged kind of recapitalization of the business, and a private equity firm or some type of other lender will come in and take a minority position. But more often than not, they're looking to take control, implement their structure and their synergies into a business. Then what is a private equity fund? Well, the fund is the vehicle in which they pool all of this capital that they receive from limited partners to go to market and act on their investment strategy. And once they've hit their fundraising goal, so you'll often hear, hey, so-and-so private equity group is, closing out their fourth fund. They will put a max capital target on that fund. And once they hit it, they kind of close it out. They don't take any more investors. And the way that they continue to grow is, hey, now that fund four is closed, we'll move on to fund five. It'll either have a similar or a different investment strategy that we had in our prior funds. Next slide. So how does private equity work? So we kind of talked a little bit about it in answering those questions on the last slide, but typically the private equity to invest in a company raises pools of capital from limited partners, and they're limited in the sense that they're not active in the management of the companies they're purchasing. They're really just silent investors with some rights that they retain. But although the investments can vary, the more common type of structure is what is referred to as an LBO or a leveraged buyout. And this is where there is a piece of equity that is injected from the fund or from the private equity fund, but also debt is put on the business that's being purchased, and it's leveraged to help pay the seller at close. And so you see that, and that's where private equity sometimes gets its bad name, is they do more often than not burden some companies with some pretty substantial debt, which if growth that they're projecting and the investment strategy works, it's usually not an issue. But on the other side, there are those stories that are out there of companies that were sold to private equity leveraged, and hey, the economy took a dip or their product line didn't quite grow the way that they thought, and eventually that comes to roost. And when the private equity firm, they typically have a time frame of their investment capital, and it's typically somewhere in that 5 to 10 year range is when they're looking to flip their investment portfolio. So when they sell one of their portfolio companies to another private equity firm, another company, another public company or whatever it might be, they make a profit on that. A portion of that stays with the fund itself to help compensate them for their time and efforts in putting together the transaction, but then the limited partners receive a distribution of that profit, and that's how they make their return on their investment. Next slide. So it's always good to put a little visual chart up there for people. So we talked through a lot. It looks a little complicated, but really these are the different parts of a typical private equity structure. You have your investors in the right-hand corner. That would be those limited partners with the capital that goes into the fund. Those three boxes in the upper left-hand corner are really the private equity firm. So the sponsor, the management company, and the general partner with the carried interest. And so those are all terms that are well known in this industry or in the private equity space, but it's a structure that's unique. It's different than what most business owners are used to, and so it always helps to walk through it. But at the end of the day, it's that fund, that big box in the middle that has all the capital that's going out and looking for acquisition. And those are the individual companies referred to as portfolio companies down below. Next slide, please. So here is a nice visual of just kind of, what the typical actions or timelines and process in the private equity transaction. So, this would be from a seller standpoint, kind of the periods of time it takes to really put a company on the market. Now, this is, as you see, a lot of these bars span a number of weeks. And it can be very compressed in certain situations if there's a really attractive target and a really interested buyer. I mean, we have clients who have closed transactions from start to finish in a couple months. Typically, it's a little bit longer than that because most often companies that are looking to sell will engage an investment banker or a business broker to go out into the marketplace, try to find as many possible buyers as that are out there and interested, and then look to drive up the highest value for their client, the selling company. And so the different pieces here, the teaser sent by the bankers, the non-disclosure agreements, and the confidential investment memorandum, those are the really early on portions of that, of marketing the company, testing the water, seeing who's out there and who's interested, and really asking for some offers. Once there's been a buyer or two who have been selected as potential partners in the transaction, then you get into the valuation and due diligence aspects of this. And this is a little bit of what my partner Don will talk about next. But any buyer is going to really want to kick the tires on a business that they're looking to invest the kind of money they are, and make sure that there's one, they understand that the numbers that they're looking at and basing their value on are good, and that they're reasonable, and that their valuation is appropriate. But two, they also want to make sure that there's no skeletons in the closet, things that are going to come back that they might have to deal with 2, 3, 4 years down the road after seller has walked away, and make sure that they have the right protections if those things exist in the agreement that makes them comfortable to continue to move forward. And during that process, the other big item here, you'll see kind of in the middle of your screen, that letter of intent. That once we get to that portion, you have really identified one buyer that has given you kind of the high level terms of the deal, the value, the structure, what they're buying, what they're not buying, and what the valuation is that they're willing to pay for the business. And then you move forward from there. And that's really where a lot of that due diligence kicks off from the financial standpoint, sometimes tax. And then at the end, we have the quality of earnings report, which again, my colleague Don will talk a little bit about, and the negotiation of the final either stock purchase or asset purchase agreement. And then at closing, all those things are signed, money is wired, and everybody, is happy, hopefully, with the result. It's not uncommon for owners to be asked to stick around for some transition period through some type of employment agreement or even some type of rollover equity. So, not uncommon to see in today's world, somewhere in that, 20 to 10% range of rollover equity to keep that seller invested in helping transition the company. And from their standpoint, maybe there's some upside of the later transaction or exit by the private equity company. So that, in a really quick overview, is private equity, the timeline of a transaction where private equity is typically included. And with that, I think up next, I will be passing it over to my colleague, Don.
Thank you, Eric. And good morning, everyone. Eric mentioned that he and Adam sit on the tax side of our practice. Greg, who you'll meet later, is valuation. And I grew up really as an auditor and got into the M&A world many years ago when I was with one of the national firms, and for the last 20 years now with Raymond. And as Eric mentioned, it's extremely active right now, so it's a good time for this topic. So I'll first introduce, and I'm sure most of you are familiar with these terms, but just to stress the importance of these in the transaction world, EBITDA and working capital. So a reminder, EBITDA is earnings before interest, taxes, depreciation, amortization. It's often used as a basis for determining an offer or purchase price. Not always. Sometimes there are other things that are taken into consideration that determine the price, but even in those situations, EBITDA is a factor that's considered in looking at it. And that's because it's really a good predictor of cash flows generated by the business. There's a wide range of multiples that we're seeing in the last couple of years. They used to be a lot tighter. A few years ago, you'd commonly see 4 to 8 times multiples, depending on different variables. Now that range has greatly expanded. And a couple of those reasons, it's driven by whether it's a strategic acquisition, industry profitability, stability of earnings, et cetera. The other major influence in the last few years has just been the shift, which I think you'll hear more about today, just with the private equity firms entering the market. Years ago, they used to come in and they'd be looking for quick exit strategies. That's changed now with a lot of the different types of private equity and family-owned equity, where they're getting in and looking for longer-term investments. So they're not necessarily jumping in to get a quick turnaround. Net working capital is important. It's a measure of the company's operating liquidity. It's really an indicator of the amount needed to support operations to allow a buyer to come in and generate their future profitability. It's a simple definition, which we'll talk about in a minute, but it's important to pay attention to it in the agreement and define it very specifically. I'm working right now arbitrating a matter between a buyer and a seller where it was not well defined, and needless to say, there's at least one party that's upset with my findings. So we'll talk about that again in a moment. And then Eric mentioned the quality of earnings. That's really a part of the process in most transactions. And you'll see a couple snippets of that on the slides to follow here in a moment. It's a common due diligence procedure. It's really to get in and, without going into full due diligence, but to dig into a seller's financial records and statements and make sure for the buyer that what is being reflected is really supportable and it's what is really happening. And it's often needed for a bank or another lender. They will want it to check the box on their side and see that everything's in order. And we can switch slides if you would. And as I mentioned, so the chart you're seeing is, the next couple of charts are snippets out of what you would see in one of the slides of a quality of earnings report. So EBITDA, the first one here is really just to come down to the adjusted EBITDA. As you can see, there's typical add backs there, and then we'll talk about the adjustments in a moment on the next slide. Taxes, question we get often. Taxes relate primarily to income taxes, so property taxes, things like that are really up in operating expenses. It's really just the add back of income taxes because the buyer and seller may have a different tax structure. The interest add back, again, most transactions are assumed debt free. There's typically payoff of debt in existing debt at the time of the transaction, and so interest is added back, of course. This one that we pulled, the other income there, I just mentioned because you might be curious. It's just that happened to be interest income, which is not necessarily always a adjustment for EBITDA, but in this case, between buyer and seller, it was agreed that that small piece would be added. Go to the next one. So the EBITDA adjustments typically fall, you're looking for non-operating things, and like the recent PPP loans would be an example of that. You're looking for non-recurring. COVID's entered into that equation recently with companies trying to reflect expenses that they incurred because of COVID that won't reoccur, and discretionary type things that may be adjusted, which could be like donations the company makes or other various items. Typically, as you can see here, we'll try and get management to go through, if we're on the sell side, and identify what they believe the adjustments should be. looking again for those unusual non-recurring items. Typically, this one happens to have 10 and 3 more down below. You'll see them ranging from a couple of adjustments to I've seen in recent deals 20 or 25 adjustments, depending on the size of the company and the size of the transaction. And of course, when management's doing their adjustments, they're typically trying to drive up the EBITDA. So you just got to be aware of that coming in. And then somebody like Raymond will come in and do our own due diligence, perhaps through the quality of earnings, and look at additional items that may be sitting out there that affect the EBITDA and the reported EBITDA. The most common items in either of these categories that you'll find are wages, trying to decide what's an appropriate wage going forward, or typically for the officers. Rent is another one. A lot of times if you get into a situation where there's a company paying rent to, say, its owner, you may or may not be below, you may be below or above market rates, so that's an adjustment. Transaction costs related to the deal itself would be adjusted out, and then personal expenses, often when you're dealing with maybe a privately held smaller company, would be an adjustment out as well. And the other thing I mentioned here is it's really a focus on typically we'll show 3 years, 2 or 3 years, plus the most recent 12 months. There's more of a focus on recent period, of course, in the what have you done for me lately category. So just be aware of that. And that's why you might see like the due diligence adjustment down below item 1 is more of a timing adjustment. So you're trying to get sometimes things into the proper period. Yeah, move on. And then net working capital, again, as I said, allows a buyer to really be positioned to generate future cash flows, knowing what it takes to operate the business on a monthly basis. The simple definition is current assets less current liabilities. But as I mentioned, I think it's very important to define the dispute that I'm trying to resolve right now is the buyer assumed that was the definition coming out of right off the balance sheet. The seller, there's some quirks in their inventory system. So there's inventory that he feels should be included that's sitting outside the balance sheet. And unfortunately, the inventory itself and the working capital definition were very, very poorly documented in the purchase agreement. So it's led to some disagreements. So that's my advice, is just make sure you pay attention to how that working capital is defined. Typically cash and debt financing are excluded, as most deals are assumed cash-free, debt-free. Related party amounts typically adjusted out or settled at closing. So I think the thing here is define it, make sure you have it identified correctly on the front end. That's really critical, because the deal will allow for a assessment at closing and a working capital adjustment that compared to the target will allow either the buyer or seller to pick up or spend some additional monies. So I think with that, that's EBITDA and working capital. And I believe Adam Williams will be next to talk about some of the tax structure.
We're going to talk about the F reorg and how it's currently the state of the art in subchapter S corporation sales. Next slide. So why do we talk about S Corp sales? Well, for the most part, mature companies that are being sold are organized as subchapter S corporations. We didn't have LLC statutes until the 1990s. And there's a big transfer of companies that were formed before the 90s going on right now, the mature companies. So when you're selling an S Corp, there's some things that people want to have happen. First of all, a buyer wants to have an asset type transaction. There's many tax benefits to have an asset type transaction for tax purposes. Doesn't have to be an asset deal for legal purposes, but for tax purposes, the buyer wants an asset type deal. There's usually some nominal cost to the seller for that, but the buyer is normally willing to compensate the seller for that nominal cost in the deal. Frequently, when we do due diligence, which has been talked about kind of by Eric and Don, people find that there's some issue with the S selection. It could be the seller just can't find it. It's from 1965, 1972. It's in a drawer somewhere, nobody can find it. It could be there may be some trust that may or may not have been an eligible shareholder at some point. There may have been a distribution somewhere along the way that wasn't perfectly pro rata. I heard a Big Four due diligence person once joke that there are no real SCorps in the world. If you give me long enough, I can find a problem with any of them. So we have these SCorps that aren't perfect. The buyer, for regulatory purposes, frequently wants to walk away with the EIN of the existing company. So they want that for purposes of not having to do new contracts, not to retail any properties. So they want an asset type deal, but they don't want to buy assets. They want to buy a legal entity and form so they can walk away with the EIN. And also, most private equity firms are ineligible shareholders to own a subchapter S corporation. What that means is the moment they buy it, if they don't do some pre-deal structuring, that S corporation they bought the stock would immediately flip to become a C corp. And private equity firms have different views on whether they want to have C corps or not, but a lot of them do want to have flow-through entities. Also, if you have a flow-through entity, you can structure many different rollover options for the seller where they can retain some deferral on a portion of their sale and receive some ownership in the company even after they depart. Next slide. So what is an F reorganization? I was talking to our partners who are preparing for this, and somebody has a speculation of what F stood for. F is actually from the Internal Revenue Code. Just like 401k, this is one of those code sections that's crept from the Internal Revenue Code into common usage. Section 368 has a subpart called capital F, and people describe this as the transaction we're discussing. Now, in the Internal Revenue Code itself, it just describes a mere change in identity, form, or place of organization. So when I was a younger person in my career, F reorgs are normally understood to be name changes, reincorporations from one state to another, transactions that have no real economic effect on the business. And Section 368 with its cap F says, we're not going to have that be a taxable transaction. However, it has now come to mean something completely different in the last 13 years. And that is when we talk about the F reorg today, almost everybody's referring to a specific set of transactions that are done to subchapter S corporations in pre-deal structure. Next slide. So Rev Rule 2008-18 was issued by the IRS, and it opined the series of transactions that you can see here kind of going from left to right would be treated as an F reorganization. This opened everybody's eyes up to a way to restructure subchapter S corporation in a way that accomplishes lots of goals. And here are the steps that we do. Step one is we form a new holding corporation. We then contribute all the shares of the old corporation, that was the old operating company, into this newly formed corporation. And we make this technical tax term called a Q sub election. It's where we treat this former company that was the operating company as what's called a qualified subchapter S subsidiary that's wholly owned by Holdco. After that, most states in the last 20 years have created conversion statutes that allow you to convert corporations to LLCs under state law easily and keep its legal entity in place. I live in Ann Arbor, Michigan. Michigan has a conversion statute. Ohio also has a conversion statute. Most states have conversion statutes on their books, and if not, they're moving in that direction. So you can go to the state and file a piece of paper that says, my company, Bob Corp, is now Bob LLC. And the IRS in this revenue ruling says that if that happens, the same EIN attaches to both those entities. It's not treated as a transaction where you have to go and reset everything. So by allowing a conversion under state law, we're able to restructure the business in a way that gets a good pre-deal staging for a future sale. Next slide. So what do we do? Well, before we had over on the left, a blue circle that says SCorp Holdco. We did the transaction steps we described in the prior slide, and we end up with the following structure afterwards, which is an SCorp Holdco. which is the new company you formed owning your old company that's now what we call a single member LLC owned by this new holding company. Now, having a single member LLC as the sale vehicle allows us to do lots of different transactions. For example, if we sold 100% of the LLC units, that'd be treated as an asset type transaction where the buyer gets good step-up tax benefits and the seller gets the same flow-through treatment they'd had if they would have sold their shares. We could also sell 85%, for example, of our new single member LLC. That would convert it to a partnership and allow 15% deferral. The 15% you still hold, you don't have to pay tax on that. And you can still have some equity in the entity thereafter. There are a lot of transactions are structured that with rollover equity as means of keeping the seller in the business for a few years with a buy option to force them to kind of stay in and transition it well to the new management team. So we're able to do these structures to facilitate the kind of transactions that private equity wants. So let's go through a list of what we've accomplished by doing these restructuring steps and created an F reorg. Well, after the deal, we will sell OpCo and then liquidate our holding company, or we can have a partnership. The operating company retains its EIN and legal identity. We don't have to redo any contracts. We don't have to seek any regulatory approval. In certain industries like healthcare, that is a critical thing because the licensing is tied to the EIN of the business. And now that we've had lots of roll-ups in the healthcare industry, this has become a really huge issue. Seller retains the risk of what we call the foggy S election, where if there was something wrong with that S election, those found due diligence, that risk is retained by the seller. So the buyer can walk away and sleep at night that they don't have to worry, is the S election bad? They couldn't prove it. They couldn't provide their election. Well, that's going to be the seller's problem and the seller's consequences not being able to provide the election, prove it. The buyer has more structural flexibility of purchasing the LLC interest than buying S corporation shares. We can create a partnership. We can create all kinds of deferral options. All those things are available now with our new structure. This transaction is almost always now requested by PE buyers when they purchase a privately owned S corp. It's a transaction that, as a tax nerd, didn't exist 13 years ago, but whenever somebody is selling an S corporation to private equity or to a strategic buyer, some version of the F reorg seems to creep into the deal documents before it closes. So this is the state of the art. We used to accomplish a portion of all these things with some other IRS code sections, such as 338H10 and 336E. However, neither of these code sections accomplished all the goals we can do with the F reorg, and they've kind of fallen out of his favor. So if you were selling an S corp, let's say 14 years ago, we would have been talking to you about 338H10 and 336E. I haven't seen one of those transactions now 3 or 4 years. 10 years ago, almost every S corp deal is one of those. So this currently is the state of the art in S corporation transactions. This is what everybody's doing. The term F reorg is now well known by everybody. Occasionally, we do have to educate some attorneys about it because they haven't seen an S corp deal maybe that's had it, but it's going to happen. If you're selling a subchapter S corporation, it's a legacy corporation, you're going to deal with the subchapter S sale. Now, with that, I'm going to turn it over to Greg.
Hey, Adam, maybe before you throw it off to Greg, I just wanted to maybe ask a couple follow-up questions.
Sure.
So I know I would agree with you. Yeah, in our S corp client base, I don't know that I've seen a deal in a transaction where it hasn't been this structure. And I've even seen some where it was, maybe just internal family transitions or some type of more friendly transactions where the 338 or 336 would have made sense. But I actually saw deal attorneys who I think now are more comfortable with the F reorg structure because they see it so often, and they actually wanted to continue down that route. In terms of just general M&A, what would you just venture to guess of the transactions we see? Almost all of the S corp ones are this type of structure, but in general, rough percentage, what would you say the amount of S corp transactions that fall into this are of our overall M&A practice?
I'd say that varies by office. I sit in Ann Arbor. Ann Arbor is very tech heavy. So tech M&A transactions tend to not be F reorgs. And the reason for that is they're companies that were formed after, I'm going to say 1995, which is when the state of Michigan adopted its LLC statute, and they were organized as LLCs. But in our manufacturing-based companies, in companies that are our tool and die shops, our legacy manufacturers, most of them are S-corps. So based on the market mix, and I know we're talking to a Toledo audience, and I think of Toledo as a community that has lots of legacy manufacturing companies. A lot of them are probably being acquired, and roll-ups right now are going to private equity. The typical seller of that company is somebody in their 70s that has founded that company back when I was, 10 years old or 20 years old. And, they formed an S-corp because that's how you did things back in the 80s and 70s and 60s. So the seller is looking at, their company, and they're deciding whether they want to have a liquidity event and have money, or if they want to have some sort of legacy and pass it on next generation. I think from what I'm seeing, more and more companies are choosing to sell. They're not choosing to pass it on next generation. And that's where we're seeing F reorg transactions. And in our manufacturer base, which Toledo will be very heavy in, Ann Arbor is probably 50-50 F reorg or some other sale transaction.
Thanks, Adam. That's very similar, I would say, from an industry standpoint. But I think Greg is on, so we can turn it over to Greg for our last piece of the presentation.
Can I ask a question real quick before we turn it over to Greg? I had a question come through on this topic.
Sure.
Is there a downside or limitations to the buyer, or what are the downsides to the buyer on an F reorg?
The buyer loves the F reorg. The buyer, in a typical transaction, the buyer brings the F reorg to the negotiation table saying, we want to structure this as an F reorg. The downside consequences, if at all, are upon the seller. Downside consequence number one is that you have to go through all the administrative steps of pre-deal structuring, plus you have to liquidate your S corporation after the deal. So that is a downside step to the seller. The other thing that the seller is there is a potential of increased tax in an F reorg transaction because it's an asset type deal. We call this recapture. But in almost every deal I've ever seen, the benefits to the buyer are so great, the buyer will compensate seller for those costs.
Thank you.
And I saw a chat just come through talking about, some of the transaction structuring to help avoid some of the gain or taxability of gain. One of those being, some type of gift to a charitable foundation or organization of the business prior to close or funds after close. There are a number of different tax planning strategies around real estate as well, and some of the things that can be done pre and post close to help mitigate that. We do work through that stuff a lot with our clients as well. But as Adam mentioned, it's treated as an asset deal. So the big important piece in those F reorgs is negotiation on value allocation, right? What are they buying and what's the value of what they're buying when you look at the balance sheet?
Yeah. And if you're thinking about doing some sort of donor advised fund structuring before the deal, that's a whole other topic, and that'll take a couple hours.
All right.
All right.
I think I'm up. Thanks, guys, for giving me the flexibility to be at the end today. I was, in spite of all the time and freedom with COVID, somehow I ended up double booked today for presenting on similar concepts at two different places at almost the same time. So I was just rushing back from a presentation at Chelsea State Bank to my lovely room at the Comfort Inn here in Chelsea, Michigan. We're coming to you live on some of the business valuation concepts. I've presented on this topic before to this group in a more detailed format, but it's always good stuff to know at a high level and just keep it top of mind. So this will be kind of a shortened, quicker summary of some of the highlights on this stuff. And then if anyone has questions, feel free to reach out to me after, or put a question in the chat, and we can talk about that after this section of the presentation. excuse me. So the key value drivers of a business, I used to do these presentations where we would go through in a painful level of detail. And when we do these presentations in person, you could start seeing people's eyelids get a little heavy and think, it looked like they were ready for a nap, because we would go way too in depth on what these value drivers are. Ultimately, it comes down to cash flow and risk. The higher the cash flow, the higher the value, all else being equal. The lower the risk, the higher the value, all else being equal. So those are really the two levers that you have in running your business when it comes to increasing value and setting the business up for either a sale, a transition, whatever the case may be. On the cash flow side of things, sustainability and lack of volatility, those are generally sought after. The less volatile cash flow is, the more valuable it is to a potential acquirer, because they know they can continue making their payments on the debt, things like that. How do you forecast it? Generally, if we're helping somebody with forecasting cash flow, we're looking at, okay, what have you done for me lately? How, in the recent past, what has cash flow looked like? How has it varied? Has there been any trend that we can focus on to forecast the future? And then what I always tell my clients is, when they give me a projection, the only thing I know is it's wrong. And it gets me some funny looks when I say that, but it really is the only thing we know about the projection, is that it's wrong. No one can forecast 3 years, 5 years into the future with 100% accuracy. You might be close, but it's not exact. So that's where we try to look at that forecast and equate the risk factors to the likelihood of achieving that forecasted cash flow. Earnings versus cash flow. Oh, back a slide, please, for a second. Earnings versus cash flow is another big one. Earnings are more of an accounting concept of earnings. Net income, earnings before tax, things like that. Whereas cash flow, that's what we're really looking at, which is after capital expenditures, after changes in working capital, add back depreciation, since it's a non-cash item. So that's what really drives that there. The rest of the items there are probably a little too in-depth for this summary type format, but those are the adjustment type of items that we make when we're looking at forecasting cash flow and using historical numbers to be that guide to the future. On the risk side of it, when we talk about small business all the way up to even lower middle market, I should have key person risk highlighted, bolded, underlined in 72-point font, because that is one of the biggest risks a lot of the time. That key man risk is something, or I should say key person risk is something that is really, really important, because that's the difference between someone having a saleable business and a job. A lot of people think they own a business. In reality, they just have a really good paying job, because it is not transferable because of that key person risk. Size, believe it or not, is the next biggest driver of risk. And again, probably outside the scope of this condensed summary version of business valuation concepts, but we can talk about that offline if anybody's interested, in how size is one of the main drivers of risk and therefore the required return of a business. Next slide, please. So these are the most common pitfalls I see for business owners when it comes to looking at what is their business worth, how do they transition it, can they transition it, what kind of buyer do you find? No one, I shouldn't say no one, but I have yet to find a business owner that truly is capable of assessing the risks in their business. Because to a business owner, things that have been going on for years and years and years that other people would view as risky may not appear as risky to them. And the reason for that is they know how to mitigate those risks themselves through their experience. A buyer is not going to know how to do that, nor do they necessarily want to do that. So they're going to view that as being above average risk, which is going to drive the value We talked about business versus a job, placing value on legacy. That's one where that can mean a lot of things. It can be continuing the legacy of a business. Someone is actually willing to take less for the business to ensure that legacy lives on. That's the practical side of things. The impractical side of placing value on legacy is when someone thinks the business is worth more because of their history, and therefore they're never able to transition the business to a new owner because they're not willing to accept a reasonable offer because they think it's worth more than it's actually worth. A lot of small business owners won't sell to a competitor because they've been in the trenches against them for 5, 10, 20, 30 years. And the thought of that competitor owning their business would just be devastating to them. Qualifying buyers is important. And that's where a transaction intermediary or a banker or somebody can help with that. The next two, taking offense to questions and being defensive. I have a client going through this right now where every item that is on a due diligence request list for the potential buyer of their business, they're saying, well, why do they want that? Why do they want that? Why do they need that? I say, well, they need to make sure what you're telling them is true. I know it's true. It's true. Your accountant knows it's true, but they need to do their diligence. Don't take offense to it. This is just what they have to do. And that's, that point probably captures both of those bullet points about taking offense to questions and being defensive. And then the last one there, only hearing the good news. That's one that we see way too often is only, and it's a great quality to have in life, but it's not a good quality to have for assessing the risk and therefore the value of your business. Next slide. So here's just a quick look at valuation trends. And for some reason, 2021 data is not available yet, even though we're in Q4 already. But you can see how there was a dip right when the pandemic hit, down to EBITDA multiples being 3.7 times on average. And then things recovered pretty quickly after that. Next slide. Volatility has been going down. You can see it absolutely peaked at the beginning of the pandemic as well. And there's been some blips along the way, but in general, volatility is actually down below levels that there were in early 2020 pre-pandemic. So good sign for the markets, good sign for investor expectations. I don't know if this is a trailing indicator or a leading indicator, but it certainly is promising for me from as it relates to the economy getting past the pandemic, but we'll see. Next slide. Private equity being a big focus of this presentation. What this represents is what's called dry powder that private equity holds, which is basically undeployed capital that they have raised from investors that they have not yet invested in a portfolio company. Keeps growing year over year over year. This is important because this is what is allowing private equity companies to be the leader in acquiring businesses right now, both by volume and number of deals and by the price they're willing to pay. These are dollars that need to be invested or used to purchase companies. And if they're not used for that, eventually they have to be given back to the investors. And it's a very bad business practice, or it's not looked kindly upon in the future if a private equity firm sits on your money for 5 years and then never invests it and gives it back to you without making any money for you. So this number keeps going up and up and up, which I assume is in advance of what is called the silver tsunami, which is this huge buildup in businesses that are going to be transitioned over the next 5 to 15 years of baby boomers that are going to be retiring and looking to sell their business. So somebody could say that this is pent up demand. I think that's part of it, but I think it's also in preparation for that, knowing that there's going to be more businesses for sale than there are buyers. Next slide. Then here, this shows, again, the private equity impact and how many deals are getting done and how many billions of dollars are being spent by private equity on making acquisitions. So you can see in 21 how significant that number is, only eclipsed by inflation adjusted 2007, which that's a little bit scary that we're up at numbers that were experienced right before we had a crash. But in spite of how much volume was done in 2020 and 2021 so far, we're still at a point where there's all that dry powder of undeployed capital. So this is what's really going to continue to keep multiples high, in my opinion, and continue to push them, and push to get deals done and consolidation, things like that, roll-ups. So private equity is there. On the next slide, my point, I think, has a bullet point right in the middle. Private equity is the 800-pound gorilla in the room. They are the potential buyer that can spend the most. They are professional. They have resources to get deals done. They can be agile. They can act quickly. It's not their first rodeo, so they have their teams in place, and that's and they're going to be prepared. So that's where, as a business owner, looking at the cash flow and risk of your business on a realistic basis is very important. Prepare, and prepare some more. Getting ahead of this and knowing what your timing is going to look like so that you can be prepared in advance of getting to some sort of a potential transaction is very important. And then kind of unrelated to the rest of my points, but very important with what Adam was just talking about. What's the tax structuring of this? How do your proceeds look pre and post tax from one transaction structure to another, and how significant of a difference that can be, and how important that is for understanding what your walkaway money is, for dealing with your wealth manager, for example, to understand what you need to not outlive your money. I think that's all that was on my section of this. I know that was fast and furious. I'm always happy to have a conversation to go over some of this stuff in more detail or specific to your business, or if there's just any general questions, please reach out. And the team is here for any questions now over the next couple minutes.
Okay, thank you. I do have some questions. Greg, you had mentioned the higher EBITDA multiples. Is this in all industries across the board, certain industries, and how long do you think this will last?
That's I'll take the first part of that question first. In general, it's industry agnostic. So yes, across most industries, except for those that have been possibly fundamentally altered by the pandemic and with remaining uncertainty. You do not see many restaurants being acquired right now because nobody knows if there's going to be more dining restrictions, things like that. So unless it's something iconic or has something unique or catering or a huge carryout business or things like that, that's an industry that probably is not seeing increased multiples. I'd have to think long and hard about what else is not experiencing high multiples right now.
Yeah, here in West Michigan, we have a very large office manufacturing base, which is one of those industries, right? Obviously significantly impacted by the remote workforce that most of us are seeing quite relevant today.
Yeah, good point. And that's in my spectrum of the world. I very infrequently see businesses like that. So yeah, there's going to be niches like that are impacted by things that even beyond the the ones that we just mentioned now. How long do I think multiples are going to stay high? That's the $1 million question. I mean, there's so many things that drive it. That private equity dry powder out there is one thing. The very, very inexpensive cost of capital right now is another thing. But then, if you get some big defaults and flights to quality, that changes things. It's hard to say. I mean, I think we've got 3 to 5 years, but do not do not hold me to that one.
Thanks. All right, so I'm going to try to combine a few questions here. So hopefully that I can articulate this. So I think it was Eric, you mentioned earlier that family businesses, you're seeing a trend that they're choosing private equity or sales over passing along the business. So one, how can family businesses compete with the private equities in the M&A market now? And two, as advisors, are you seeing a lot of the personal struggle between, I really want this business for my family, I want to pass it down to my children want it, but it's really hard to turn away this kind of money. And how do you navigate that with them? How do you advise them?
Yeah, so you hit right on it. I'd say a good example here in West Michigan is a client group that we have who recently, went through an exercise looking to pass the business from generation 2 to generation 3. At their board's urging of just making sure that they were, thinking of all different avenues that we helped them with. I think Greg did a valuation project for this client, came back with a number. We walked through it with them, just helped them understand what that might mean if they went to market. At the end of that conversation, very appreciative that we went through that with them, but we're very comfortable to continue down the path of next generation is really engaged in the business. We think there's a lot of opportunity for them to continue to drive growth. Less than 2 weeks later, 2 unsolicited offers come to this client at a 30% uptick of a purchase price over what Greg provided and we did all of our modeling with. And that conversation quickly changed from, wow, that's a real number now, a lot larger than we ever thought. And maybe next generation will be very happy running a family office instead of an actual operating business. So that is a very common conversation going on in the marketplace. So the first question there around how do family businesses compete in this market? Again, the business is the business and they can continue to compete, but we do have clients, right? Family owned or closely held businesses that have their own growth strategy and acquisition strategy. The biggest issue right now is they are competing against this high multiple, high value private equity buyer as well. So they, I would say, have to find those right companies where it makes sense to pay that price or play in that space, but they are still finding those right fit. There is that seller out there who has a bad either prior experience or vision of private equity and what it does to businesses and are looking for those strategic, other family groups, other privately held groups that they feel are a better fit going forward. It just, again, the value piece of this right now in the marketplace is hard to compete with.
Yeah, as far as the competition issue, I mean, that can be huge in certain industries. The industry that I dealt with this summer is we had a client that was in the ready mix concrete business, and there were some large players doing very large roll-ups of all these small ready mix concrete companies. And they decided to sell for the purpose of, once these large companies get critical mass, we won't be able to compete with them on pricing. And we're a commodity-based business. So they chose to sell because they saw that was where the industry was going, and they wanted to not be the last person standing that went bankrupt instead of taking the private equity money. The other thing I think is terms of the choice to sell or versus pass it on to your family that I've seen is a lot of businesses, the owner founders have been going back and forth about whether to pass it on or to sell for 10 years, kind of in this paralysis analysis. Are the kids ready? Will it survive this or that? And I think that the pandemic has focused that conversation on, I need to make a decision and go. And we're seeing a lot of that activity right now this year where clients we've had that were going back and forth and selling or not selling are saying, hey, I'm going to sell my business, or hey, I'm going to do a big gifting transaction to push this business down to my children.
And Eric, I think you mentioned a good point, is just companies thinking about it, just reaching out to Greg for evaluation or even some sell side due diligence on the front end, just to confirm what EBITDA and multiples might be, helps in that decision process as well.
And I know that just yesterday, I reached out to Greg about a client that was going on the gifting route, making a substantial $20 million gift stock in their company. I reached out to Greg about doing evaluation. And it seems like everybody's reaching out to Greg about doing evaluation. So This is the peak time to be a valuation expert right now,
Yes.
with the proposed tax laws, with private equity pushing lots of money in the marketplace. Everything's coming together where everybody needs valuations.
Yep. Yeah, I fear for my holiday season.
I know we're at 9, but I have 2 more questions I'd like to get through if that's okay. Is there any tracking of the long-term viability of companies that are acquired via PE, private equity? And with the amount of leverage, do these companies ultimately struggle or do they thrive?
I've never seen anything as to long-term viability, but I think I think the thought that there's an overly large amount of leverage always associated with private equity might be a little outdated, because they have so much money from their investors to spend as equity right now that sure they will lever them up in a way that makes sense, but I don't know that they're necessarily levering them up more so than non-private equity buyers.
I don't think there's tracking, but you can find examples in every direction of companies that knocked it out after a transaction or companies that failed. I think the poster child of failure here in Michigan is Art Van Furniture, which got acquired by a private equity firm and was bankrupt within 2 years. And obviously they over-levered it. There was a tick down in their sales and they couldn't fund their interest. However, I've got a client that is in the auto industry that has been purchased in a roll-up, and it's a SCorp still, so I still do their work. And the additional purchasing power they got by being rolled up has enabled them to get better pricing on their products versus the OEMs. And they're much more profitable now than they were before they were purchased by a private equity firm.
And the viability, Angie, I would say the private equity has evolved a lot. Used to be quick exits. Now, it's sometimes longer exits, or even a lot of the funds now are investing long-term in their companies. So I think the viability in those situations is much more stable.
And you're also seeing a bigger player in this kind of private company transaction space of family offices. So wealthy families who have an alternative investment arm, and they are typically not looking for a quick flip, but much more a long-term hold as part of their family strategy.
And that's a different type of private equity we're used to seeing. I have a client that's in I'll call it a tech/automotive startup. So they're, it's tech enabled, but it's essentially for automotive technology. And their private equity funder that is funding their growth is one family.
Okay, so this next question, this will be our last question, and I think this could warrant a whole hour discussion on itself. But do you have any quick comparison, pros and cons versus private equity versus ESOP?
Oh.
Yeah, that is a topic for for a very long discussion, but go ahead, Greg.
I will say on the pro side, if we're looking, from a seller's perspective, on the pro side, private equity is generally going to pay more because they can pay some sort of synergistic premium, whereas an ESOP cannot, per Department of Labor and all sorts of crazy rules. On the con side, I think ESOP is a way to guarantee legacy, if that's something that you're concerned about, and it's a way to guarantee a future for your employees, which I think everybody's concerned about. So I've seen a couple clients that went the ESOP route that took a lot less money than they would have gotten from private equity or a non-private equity external buyer for those two purposes, for legacy and for their employees. And they didn't need the money. They could live happily ever after on what they could get from the ESOP, so it made the most sense for them. Those are the main pros and cons that I see. But like you said, that's a 1-minute answer, and we could talk for an afternoon on it.
Yeah, and I think something else I see, and I think would be a pro and con, at least more often than not, is how fast do you want your transaction value. So, with a private equity deal, if it's a majority purchase, it's at the flip of a switch. Maybe there's a small holdback that's paid out, in 90 days, and then maybe some reps and warranties in another 18 to 24 months. But ESOPs can tend to drag out longer, to the extent that the ESOP's trying to buy shares based on the cash flow of the company. Anything above and beyond that needs to be leveraged debt. And a lot of that tends to be seller notes that are paid off over time. So in general, now there are those exceptions to the rule, but in general, I would say that's what I see as well.
And if you're going to go the ESOP route, there is a lot more complexity in the transaction than just selling your business. A lot more advisor fees, legal structuring. It's a very complicated transaction. It's not an easy like, hey, give me a check, here's the shares.
Mm-hmm.
All right, well, that's all we had today. So thank you so much, Raymond. We appreciate all of you being here and presenting and sharing this information. We did record the session. It will be up on our YouTube page and we will email that out. I believe everyone that registered already received your bios and the presentation deck, but we will make sure we get that, resend that out to those that attended along with the link where to watch it online. So thank you, everyone. We appreciate you joining us today.
Thank you.
Thank you.
Thanks for having us.